Analysis is only one part of trading. The entries and the exits are what matter most, because it's this area here where the money is actually made. So in this video, we're going to talk through entries and exits. I'm going to show you how to form the highest probability entries for your trades, how to maximize profits with your exits, and how to plan contingencies so that if a trade goes bad, you can still get out for a minimized loss or even a profit. All of these things are going to help you to become a better trader. So without further ado, let's get into it. So what exactly makes a good entry? Well, for our entries, we want to look at high probability and maximum profit potential. If we can achieve these two things, we will have a good time trading. To achieve high probability, we realistically need to be in line with the trend, and we need to have our stop losses safely positioned so we don't get stopped out on a trade that's actually correct. To maximize profit potential, we need a reasonably tight stop loss because this will allow us to build our risk reward along with a refined entry. These two things together create large risk reward, which will amplify the profits that you can get from your trades. So there is one great entry model that does all of this, and that is this entry model here, which I call a confirmation entry. Now, to run you through how this entry model works, basically we're looking at price structure. So the idea is here for a buy side example, which is what we're looking at. This would be your buy point. You'd be looking to take the market higher. What you want to see here is a market shifting from lower lows and lower highs into higher highs with a break of structure here and higher lows. And when the market creates this shift, the formation of this higher high, which pushes over the previous structural lower high, this is the point where the trend has shifted, which provides great opportunity for you to take a buy because we know the market is now impulsing to the upside, and we can actually look to essentially join here and ride with the next movements of the market. So there are a few aspects to this confirmation entry. The first is structure. We need to have a clear understanding as to which way the market is going by identifying the highs and lows. In a bearish example where the market is creating lower lows and lower highs, we will be looking for a shift into higher highs, and when we form a higher low, that's where we get in. The second aspect is going to be supply and demand. Now these are zones that you can buy from. They're generally created as a consolidation before a large upward move. In the case of a demand zone, we use this to actually place our buy order. In this confirmation entry example, after we've created this higher high, we would look for the market to pull back to the clear demand zone, and we would look to buy from that clear demand zone with targets extended. We're going to talk about those soon. And our stop loss would go underneath the low of the trend. So what we've actually created here is a high probability opportunity. Why? Because we are moving with the new direction of the trend. Break of structure here. We are now moving in an uptrend because the market's forming higher highs and higher lows. And the second thing is we've created a high risk reward area because what we've done is buy from what we can essentially call an extreme point of interest. So the market's pulled all the way back to its lowest point, which is where we've looked to get into the trade. This allows us to get the refined entry and also the tight stop loss that we want. But because the stop loss is situated underneath the very low of the movement, it's also a high probability stop. So although it's quite tight, we shouldn't lose this trade unless we are wrong about the position. Now, of course, sometimes, being a probability driven market, we will just see this movement take place. When this happens, we will lose a trade. But we won't lose a trade until we are proven wrong. If the market comes down to here, providing it doesn't break underneath the lower low, it can still move higher. So by having our stop here, we're in the most optimal place. We limit our losing potential and we have a high probability trade. But if we are proven wrong by the market, we're out for a quick small loss. And the exact same entry model, but flipped upside down, can be used for selling trades. Here we're looking for a market that's shifting from higher highs and higher lows into lower lows, creating validation of a downtrend. Then we can sell from a supply zone, an area of consolidation before a large down move. We get our entry here, stop above the high, which provides a tight but safe stop loss. And then we get to maximize profit on a high probability position to the downside. Now, the coolest thing about this entry model is that you would expect it to only be used in reversals like this, so where the trend is completely shifting. Now, these are great entry models for catching reversal trades because you get to catch the start of a new trend and you can run the market down for quite some time. However, we get another benefit from these, and we can actually use them in continuation trading. See, what we can do here is actually use demand zones inside of an uptrending market, like this example, and we can use the confirmation entry inside of a demand zone. So although the confirmation itself is showing a reversal, we will essentially be looking at a reversal of the shorter term price action. So if the overall trend is up, inside of these areas here, or these areas here, we're going to have short-term downtrends, right? So what we will be looking for is a break of a short-term downtrend inside of one of these price ranges as we come to meet a point of interest like a demand zone, and then we would place our orders to buy, our stop loss beneath, and look for the market to come in, retest here, which would be this instance here, and then we take the market higher from there. The concept there is we're seeing high time frame agreement, which is an uptrend, and we're seeing low time frame agreement, which is a shift in the small trend. So when we see that break of structure there, we can confidently buy this higher low because we know the larger trend is up and now this smaller trend is up as well. So it is not an entry model reserved just for reversals. We can use this reversal theory inside of the smaller trends in pullbacks in buying markets, and we can actually use the confirmation entry to confirm continuation trades as well. Okay, so taking a look at this example, this is a bullish market, and we're going to break down the confirmation entry from this trend. So it's pretty clear at this moment, if we take a look at the highs and the lows in structure, that the market is in an uptrend. It is continually forming higher highs and higher lows, okay? So in order to validate a confirmation entry, we'd essentially in this instance be looking for a bearish reversal. We'd be looking for the market to move down. Now, while it's in its process of going up, we could simply continue to look to buy demand zones. But if the market does create reversals, that is then going to open doors to utilizing the confirmation entry so that we can get some good trades. So the first thing we need to do for this confirmation entry is mark out the structure. The current structure, the only structure that really matters to us right now, is the structure that is taking place in the current zone, because this is the current leg of movement. Now what we want to do is mark our high, so the trend high is going to be there right now. And we want to mark the higher low that led into this move. So we're essentially looking for the higher low. Now, because we had this wick driving down slightly under this low before the high was formed, our actual higher low is going to be the bottom of the wick. We want to make sure we've got the full range covered, okay? So at this point, we have our high and we have our low. For a reversal confirmation entry, we would want to see this market come and close underneath this level. So we would need to mark this area for closures. That is what would validate the reversal. And that's what allow us to actually utilize the confirmation entry. So if we run this market forward a little, we see we have this bearish candle, which closes underneath the previous structure. And now, if we consider what we discussed, we are actually seeing the confirmation entry in action, right? So we have all of this formed so far. We have the break of structure, which is this level here. The break is just there. We have a closure, which is just here. We have our lower low, which would be the low of the wick, but the closure is essential, by the way. You need to see the candle close underneath the structural low in order to actually provide you with your validation, okay? If this was just a wick and then the market pushed back up, that would be seen as a rejection. So this closure, the fact that this candle, this gray candle here, closed beneath this low is essential. So we have everything up to this point, and now of course we like to use supply zones for our entries in a selling opportunity. Now, as I said, we are essentially going to be looking for consolidation before a large down move. Well, we can see here we have a consolidation where the market has moved sideways, and then we have our down move, which has created the bearish break-in structure. Our supply zone, therefore, in my trading personally, is going to be the last candle before the impulse. So an impulse is, of course, this movement. It's the impulsive move that's broken the trend and created a new downtrend. The last candle before the impulse is this blue candle before the push down. So what I would want to see here would be for the market to return to this level, and then I would sell into this movement because this is now the supply zone that essentially kicked off the move. The idea is if we get back to that level again, we should see new selling pressure coming in. So for this trade, we can now go ahead and place an order. Our entry would be on the supply zone. For safety's purpose, we can put the stop loss above the high. This is going to be around a 30 pip stop. We're realistically usually just going to be looking at risk reward profiles as opposed to the actual amount of pips. Of course, if we can push this for a very big target, in this instance, we're going to just go for a 1 to 3. We'll talk about targets soon. Then we can maximize the profits, okay? So pips don't really matter too much, whether this is 30 pips, 3 pips, 10 pips, 15 pips. What matters is the risk to reward. So in this instance, the risk to reward ratio is 3, meaning if this trade wins, we win 3 times what we risk. This is a good level to go for. If you can do that consistently, you only have to win around 40% of trades to be rather profitable. So now we have our full validation, okay? We have our higher highs and higher lows breaking into lower lows. We have our supply clearly defined. We have our order placed, and we are looking for what we've covered previously, which is to sell from supply, and then to place our entry on the supply, stop above the high, and target down into wherever we're going to target. We'll talk about exits after we've covered these entries. Now, if we allow this market to run forward, you see, we get a tap in to that area of supply, and the market reverses completely, actually pushing down considerably more. Now, this allowed us to catch the start of a reversal trade, okay? But as I did say, it can also be used in continuation. So let's go and take a look at an example of that just now. All right, so here's an explanation of continuations. Here we have a market that is consistently making higher highs and higher lows, all right? We can see that the latest printed structure essentially looks like this. We have a high, low, high, low, high, low, high. So for a continuation trade, we would be looking for the market to pull back and then continue trading higher, right? Now, obviously, in this instance, if the market was able to break underneath this low with a push down like this, that would validate reversal, which would then allow us to capture a reversal confirmation entry. Providing the market stays above that low, we can look for opportunity for our confirmation execution. So we'd want to see a movement like this taking place, which would essentially validate that this low time frame structure here is reversing to the upside in line with the high time frame structure, which if we average it out is of course also moving to the upside. What we can see is we have this area of demand. Now this has pushed down lower. This is what we call a data-driven wick. So if we're marking an area of demand somewhere that's been affected by economic data, where the market gets messy, I'd essentially look at this last candle before the impulse, which is the consolidation, but I would draw the zone down to around wherever the low is, right? So this creates quite a large demand zone, a little bit difficult to work with, but providing that we see this confirmation entry somewhere inside of this demand, we should be good. Now we could also use, if we wanted to, the fib area between 721 and 88. I like that area. This would be the prime area to see reversals in. That's just the 71 to 88% pullback from this low to this high, okay? So anyway, we'll leave that for another video. We need to focus right now on the entry. So the next movement is to wait for this market to align. So if we take a look at this market from a 15-minute perspective, we can see that we have from this high some downward trending structure. Most significantly, inside of the movement that we are currently looking at, we've seen the market create this lower high. We then saw it create this lower low. And if we take a look at what the market has now done with this push up here, it's actually gone and created a higher high, okay? So this tells us that this market is reversing. We have our break of structure line, which is here. We have our push to the upside to create a new high, which is here. So what do we do now? Well, we're going to look for a demand zone to buy from. That's going to be last candle before the impulse in this market. That's going to be this gray candle before this bullish impulse away. So this would be our area of demand. For this movement, we can actually now refine the entry and the stop loss. Targets wise, let's keep it really simple. We'll just go for the next high, okay? So we can place our buy limit order on the demand. We can put our stop under the low because we know if the market is able to get under this low, that would reaffirm the downtrend. That would basically break what we've seen in this uptrending structure, and it would just drive us back into a downtrend, right? So if we saw this movement taking place, essentially this break here, we don't want to be in this position anymore. So we would be happy to have our stop loss there and accept if the market gets that low, we'd rather not be in the trade anyway. For our target, we are just going to look at the next swing high. Being a continuation trade, essentially what we look for in continuations is for the market, when we get into a trade, to at least go and take out the next high. So in this instance, this is our previous low. This is our previous high. Now that we've pulled back around 80% of the move, we're going to be looking for at least a push up towards this high. Now for continuations, you can of course look to extend your targets further, but we're just focusing on entry models at this moment in time. So we're just going to be simple and use that high. So your trade would look something like this. As you can see, the market comes and taps into the area of demand. Following that, we then start to see this market pushing to the upside, and eventually we see that target met. Okay? So that is a full breakdown of a continuation version of the confirmation entry. You can see that to get this position, all we did was identify a market that's moving up, identify an area the market is likely to reverse from, and then identify agreement on the lower time frame. So when we saw this trend breaking to the upside, we know this is a bullish trend in the short term. We pair that with what we see on the high time frames, which is a bullish trend in the long term. And now we have agreement across time frames, which allows us to comfortably get into a trade to take the market up towards the next high. So that is the way that we approach confirmation entries from a continuation perspective. Right, now we need to talk about exits. So what makes a good exit? Well, high risk reward is one of them. We want to make sure we're maximizing profit from our trade, but also high odds of being met. It's no good getting into a position if it's no good setting up a trade with a target so big that it's probably never going to get tapped. So for high risk reward, we need to make sure that our trade target is not too close to the entry so that we're not getting out of trades too quickly. And for the high odds of being met, we need to make sure that our target is sitting in a logical area that is likely to be hit by price at some point in the near future. Let's go to the charts now and talk about some good exits. Right, so in the case of a continuation opportunity, so when you're trading inside of a trend, the simple target, the most simple target that you can select is going to be the previous high, okay, the local high. So, for example, if you've bought the market at this low, the most simple target is going to be this high. We know the market is moving in an uptrend, so on its way to creating a new high, the easiest place to just get out of a trade with a sure win, or as close to sure as you can get, is going to be just targeting the previous high. Once this movement has been created and you buy this pullback, just target that high. That's going to be the most simple, logical target for you in a continuation setting. Again, then, if you bought here, you would target here. If you bought here, you would target here. Because you know, if the market continues in this uptrend that you're buying, you're going to get these targets filled. To showcase this in a real example, of course, the trade that we just looked at over on this pair, we used this as the target, which is simply the local high. So we get in here, we know on the way to making a new high, it's going to pass this level, so we can take profits there. Same case if we'd bought here, you would look at this local high as your target. If you bought here, you'd look at this local high as your target. If you'd bought here, you'd look at this local high, and so on and so on and so on. So that's the easiest way to use targets in a continuation trade. Now, there are other ways. Let's take a look at some now. Now, sometimes you are, of course, going to want to take your targets further than just local highs. Because, of course, in a continuation, you understand the market is likely to keep going after you've made your entry. So therefore, it makes sense for you to want to extend targets further, and it makes sense to actually do so. Now, this also goes for reversal trades. Let's say in this instance, you'd gotten into your trade all the way down here at the low, right? You'd got in at this low. You don't want to just take profits at the local high because you're getting in at the start of a new trend. And if you take all of your profits here, well, then your trade is going to be very small compared to the potential that it actually has. So what we're going to do now is take a look at using previous areas of interest to actually select your targets. So in this example of an uptrend, let's say we have one buyer who got in here, okay? Don't worry about the entries for this example. I just want to focus purely on exits. You've also got a buyer who joined the trend at the latest point that we just discussed. So he is in over here. Now, when it comes to choosing targets, we can actually look to the left. So in that instance, we're going to be looking over here. And we can use price action to the left to determine where targets could be. To do this, we can use, and the most common thing I will use, is supply and demand. So those zones, those areas of consolidation before large up or downward moves. I'm going to jump us to the 4-hour time frame here so that we can see zones a little bit more clearly and get a better zoomed in view of the market that we're looking at. So what we would do then is simply look for areas of supply in this downtrending move, and we use those for our targets in this uptrending move. Because we understand that these supply and demand areas are where the high probability reversals take place. So here we have this last candle before this impulse down. We could use this as one of the targets for our trade. So we could actually take profits once the market comes into this level. We can even look higher, and there are actually further supply zones that the market could potentially reach into. So if we wanted to, we could use, for example, this target for our trades as well. Now, we can do something we call partial profit taking. This is somewhat of a contingency plan, and that would mean that when we had this first supply zone, we could potentially take a part of the profits, or a partial, here, but we could leave the rest of it until here. Now, I'm going to see how the market runs. We can see that in this instance, the market's actually come down, created a new higher low, and then pushed up towards that overall target, okay? So had we taken these trades, we would have obviously filled the full target. But by taking partials, for example, at this first area of supply, so if we'd taken, say, half the position here, this guarantees that even if the market was to create a full-blown reversal after hitting this target, stopping this position and this position out, we would have still made a profit on both of these trades because we'd have taken some profits here. And then by continuing through to this overall target, yes, we take a smaller profit overall because, of course, we took some here, but we locked the rest in up here. So that's one contingency method you can use to make sure that you profit even if trades do reverse on you. But you can see how simple this is to use these areas of supply as your targets. Now, I'm not sure how this market reverses or if it continues from this point. Let's take a look. You can see, though, the first point of which the market actually started to slow down significantly was indeed this area of supply. That's why supply zones can be so good to determine targets for buy trades. Because if anywhere is going to actually create a reversal, it's going to be supply zones for the most part. So by taking profits at the supply zone, you're basically setting yourself up to win, even if the supply zone creates a large reversal in the market, because you got in here, you got out here, and now if the supply zone reacts, it doesn't matter to you because you're already out of the position. So the easiest way to find high probability targets for your trades is just simply to look to the left. As long as you have some price action to work with, which you will in pretty much, I'd say 95% of scenarios. Only if you're trading to all-time highs does this become difficult. But if you are trading not in all-time highs, which is the majority of markets pretty much all the time, you can use previous price action to actually target for your new trade. So in a buy scenario, look at previous areas of supply. Example's sake, in a sell scenario, you would look to the left and identify previous demand zones to actually take your profits at. If you have multiple zones, you're not sure how far the market's going to go, you can of course do that partial taking system we discussed, meaning you would take some profits here, and then you would leave the rest to run down to here. So to visualize and recap everything we've covered so far in this class, the best entry model is a confirmation entry like this, using that structural shift and demand to buy into the market. It can be done in the case of a reversal, such as this market reversing from down to up, or it can be done on continuation trades. If a market is already moving up, you can use the lower time frame price action to join the market and take it higher from an area of demand. This would be a continuation, this would be a reversal. When it comes to taking your profits, there are a few areas you can do this. The simple way to approach profit taking is going to be local highs. This would be the easiest way to get into a position and get out of a position by simply targeting the local high. However, this does limit your profits, so for many of your positions, you probably want to take the market a little bit further. That's completely understandable and probably a wise move. So the best way you can do this is to use previous areas of supply in a buying move as your targets, as these are the high probability reversal points. If there's going to be anywhere the market flips, it's usually going to be from a supply zone against an upward move. So using these as your targets would be a very good way to make sure you lock profits in before market reversals take place. It also allows you to extend your targets further than just the local highs. Now for contingencies, as we discussed, we always want to make sure we can get out of a move with some profits. If we ran a market this far, there is no reason to let this reverse all the way on us. So for contingency exits, we can actually use that partial taking approach, which would mean taking, for example, 50% of your profits here, and then taking the other 50% up here. This way, if the market gets halfway up to this area, or if it just straight reverses from this supply and makes a big push to the downside, well, at least you've made a nice profit of a few percent before that reversal took place. So always planning those contingency exits and making sure you're prepared for the worst case is a good idea too. Now, there are a few other contingency exits that we can cover, but I'm not going to do it in this video. If you click the video on the screen right now, that's going to take you to a video where you will learn all about stop loss trailing and some other methods you can use to protect your trade. So I hope you've enjoyed this one, and I hope you enjoyed that one too. Thank you for watching, and I'll see you in the next video.